Hello and welcome to Big Deal. I'm Nisha Poddar. Now let's talk about the startup space today, as the first signs of a massive down round has already emerged, with PharmEasy being the biggest talking point. But over and above that, it does have the color of an M&A, as a strategic investor comes in to the rescue as a white knight. Now, this is the story we first broke right here on CNBC TV18. So let's jump straight to the discussion on the M&A trends emerging in the cash-strapped startups and unicorns. Let me welcome on the show today Anuj Golecha of Venture Catalyst, Sumir Verma of Merisis Advisors, and Shaurya Bhutani from Capital Connect Advisors. Gentlemen, welcome to CNBC TV18. So we're being an iBanker, a deal maker. Let's begin with the most recent topic on PharmEasy. What's the sense that we should really take from this particular PharmEasy transaction that's going forward on the M&A trends that's emerging now?
Well, so I think we saw some of that even prior to this. As you know, I think I would put this as one which falls in that bucket of where tech meets the existing large players in the market. Right? So, for instance, Big Basket now has Tata's on the cap table, pretty much running the company. You've had Reliance doing a lot of it, etc. Builders are getting active too. So, I think this is really where the tech startups who have been innovating in an existing market space are now, I would say, syncing up with the guys who already been there and large players, honestly.
Right. So taking off from there, Anuj, you come from the venture capital fund space. Now, how are the investors really looking at the scenario on startups being cash-strapped at the moment and the kind of valuation dip that we are seeing?
Yeah, hi, Nisha. So for investors, I think there cannot be a better time, because the vintage is so good. See, there's no dearth of innovation in India, and there's no dearth of good startup assets in India. It's just that the entry point of valuation probably has become more rationalized. So if people are able to enter good companies at the best price, there is no better time. Even if you see the current transaction which you're seeing, an industry veteran coming in and backing PharmEasy, a sector expert. Mind you, they are altogether putting 2,400 crores approximately, which is huge capital, right? So the execution capability and the fundamentals of the business are still being backed. For an investor, the price couldn't be better. If you see their other assets, even like Thyrocare, they are getting PharmEasy for like absolutely negligible prices, right? So for an investor, it's absolute best time for investing. We are very, very optimistic in the scenario. And while, yes, there are valuation dips, and it's bound to happen. 2021, early 22 was bull run because of liquidity. Now you are seeing rationalization happening, but fundamentals of the business being backed, and a lot of capital in good assets being deployed yet.
Right. Since you yourself mentioned the Thyrocare example and what's happening right now, Anuj, I have a counter question on this. See, the venture capitalists as well as private equity, the investors have their skin in the game. They have a lot at stake with many of these unicorns which are seeing the valuations dip and the businesses suffer. Now, in this particular example also, we have seen a very good trend emerging where Temasek and TPG, which have been common investors in a Manipal Group company as well as in this company, have stitched together this transaction and brought in a sort of a white knight. So it goes much beyond the down round scenario. It comes to the survival and deal making leading to these transactions. Is this one trend to view where VCs are going to be much more proactive in deal making?
Of course, it has to happen. See, not just startups, but if you consider any asset class, such things are bound to happen depending on the business scenario. The pricing of the asset will go up and down. We do it in public market. It happens in real estate and any other asset class. So this is not something different if a company was valued in 2021 like around $5 billion, and it was a sector where multiples were very high because of COVID, it was able to capitalize on it. Today, the business numbers still are good, right? And things like these are going to happen. As far as people like us who are into investing and deal making, this is one of the directions to go. See, M&As have been prevalent in the startup ecosystem, not just now, for last 10 years. You are seeing larger companies coming in startups like the Geo and the Tata and the other platforms. You are seeing staggered acquisitions happening where a Marico acquired a Beardo, and likewise you are also seeing where startups are acquiring startups. Oyo acquired Innovate and Swiggy acquired Super Delhi, and so many such transactions. At the same time, you are seeing startups acquiring traditional assets and M&As happening, right? That's the fourth way. And like we see, there would be some distress situations where there is a question of survival. And if the asset is good, the fundamentals is good, more importantly, the execution capability of the founders is good, there is value on the table, investors will come. So these are 5 ways where M&A is definitely happening since last 10 years in the startup sector.
That's right. And some of these trends are quite visible also, Anuj, at this point. So, Shaurya, looking at the present, atmosphere and the environment that we are seeing in the startup M&A space, we have seen Bulbul acquisition, we have seen Ustra, and the kinds of consolidation theme picking up. What are the trends that you are really keeping on your radar?
Yeah, absolutely. Nisha, first of all, thank you for having me on the show, and great to be here with Anuj and Sumer. In terms of when we're looking at I guess M&A consolidation from a cross-border perspective, or even domestic cross-border domestic acquisition perspective, the themes driving M&A is this, right? There is a lot of startups in Series A, B, which were planning to raise in 22, 23, and now, of course, because of the funding winter, that it is dried up, and effectively M&As are serving as I guess a beacon of hope for these guys, because on the buy side you've got Anuj mentioned the larger startups who are still cash rich and can enter assets at very attractive prices. I think we're seeing some larger startups making moves into the smaller counterparts, which is a big theme for us. And second, of course, is the traditional corporates, like of course Reliance has been on a rager, but other than that, even Manipal entering, PharmEasy. It's a very interesting time we live in, because for the longest time there used to be this I guess animosity between the old world and the new world, or the new age startups and the traditional companies, because they never could see eye to eye on valuation. And now that the valuations have dropped, and the traditional guys can get their heads around the valuation piece for new age startups, they're seeing this as an entry point to enter the digitization wave for themselves, right? So that the second piece around the traditional guys, really, the family-owned conglomerates going after the new age startups, we're seeing that theme and quite interested in that theme.
Yes.
Even from a cross-border perspective, we're seeing a lot of interest into India.
So one very important point that you mentioned, and we have seen some bit of that happen. In fact, PharmEasy Thyrocare was one of the biggest omni-channel transactions that we had seen. And now, of course, it's going forward in other companies and other spaces in digital economy as well. Sumer, what's your sense on this omni-channel approach and the big boys really coming in and lapping up the digital companies which are now coming cheap?
Yeah, absolutely. I know, I think Shaurya made a valid point that the valuations that they used to command were not something that these people would have bought into, right? And I think this is where the rubber hits the road. And in reality, actually, we generally say that when a company gets mature, the valuations tend to become more real. This is happening even before these companies are maturing because of the circumstances that's happening. And it's a reality that pretty much all businesses, and the deals that you're flashing right now, a lot of them are consumer companies, as you can see. Essentially, it's omni-channel play, it's also multi-product to push to the same channels, right? So,
Yes.
I mean, if I just look at this first half of this calendar year, there were around 35 odd deals that have happened till now.
Yes.
And by far the largest has been fintech, and we can talk about that separately. But the next in line is consumer at around 13. If you add the ed tech and the healthcare, then it will be more like 16, 17 deals. A significant number of them have been done by consolidators who are there to consolidate, right? The Good Clams and the Goat brands, etc., and Reliance, right? So Reliance did Central, Reliance did Rusk Creek, etc. So essentially, it's a combination of not just omni-channel, but adding multi-product to an existing multi-channel, omni-channel approach, right? So it's a bit of both, actually.
That's right.
To this point, I can talk about fintech separately.
That's right. No, so Sumir, you added another dimension. Yes, that's another trend that we had seen and now is picking up hopefully more. So we have discussed actually a lot of trends that are emerging, but we'll take forward the conversation on more of the factors which are going to drive the valuations and how do we see even the fundraising, IPO and other forms of exits play out from our esteemed panel right after this short break on Big Deal. Stay tuned.